Welcome to the StoryLens Podcast, where your story is our focus. We explore wealth, legacy, and purpose through a process that starts with deep listening and leads to one-of-a-kind strategies. At StoryOne, we believe the best planning begins with you.
Welcome back to the StoryLens Podcast, where your story is our focus. I'm Kenny Conklin, and I'm here with John Christensen and Cameron Bond. We are the partners in StoryOne. At StoryOne, we believe that meaningful wealth planning begins with deep listening, and that the best strategies reflect your family's values, purpose, and long-term vision. In the last podcast episode, we had Amy Minnick from the Impact Foundation, and it was just an amazing kind of background of Amy and how the Impact Foundation came about. If you're interested, please go back and watch that. It's really, really good. Today, we're going to be tackling a big question. What's the right mix of assets for your family's balance sheet? We'll walk through different types of asset classes like public markets, private equity, real estate, venture capital, and even cash to some degree. And we'll discuss and think about liquidity, diversification, and aligning your investments with the story you want to live and leave behind. Whether you're navigating new wealth or refining a long-standing strategy, this episode will give you practical insights on building a thoughtful, well-balanced portfolio. So let's go ahead and get started. Asset classes. Let's talk about those a little bit. What are some of the types of asset classes that families of all levels of wealth invest in?
For me, I think about it as the kind of the two big buckets. One is public markets and private markets, right? Public markets are things you can trade daily, typically. Stocks, bonds, mutual funds, ETFs, and then even on the debt side of things. So that's really that category. And then private markets, that's where it gets, sometimes that's just called alternative investments. And there's a lot of different categories there. Kind of the three broad categories that we talk about often are venture capital, private real estate, and private equity. And then within each one of those three categories, there's a multitude of subcategories. And so it's just a little bit dependent on how you would look at it. I mean, a lot of families we work with are business owners or former business owners. So that business is on their balance sheet is a private market, and then it's, a lot of times the majority of their wealth. So I don't know, Cam, do you have any thoughts? Or?
Yeah, no, that's a pretty clear breakdown. I mean, there's, I think the families that we work with and come across, most, as John already said, a lot of them are business owners. They start with a business, and then as they gain wealth, they get into public markets. They go, obviously through a 401k is a very traditional way to just kind of dabble in, like, oh, I own the S&P 500. And as liquidity increases, often there's a desire to get into real estate, whether that's, owning small rental homes or whether it's more commercial things. Or large funds. And then, I think in the last decade, there's been a little bit of an explosion in the private equity venture capital space. That's, there's an attractiveness to that space. It's pretty unique. Obviously, there's a lot of stories about tremendous success there, but there's also a tremendous amount of risk in it. And so I think as John and I have been working in this space for a while, as we've reviewed hundreds of deals in the private equity venture capital space, we've definitely grown a little more skeptical of that asset category, at least in the current environment. Like there's, it won't stay that way, I'm sure, but I would say deals often come across that look super attractive. It's pretty exciting, someone sold it really well. But the risk reward, as we've watched them over the years, is often a little too high risk, a little too low on the reward side, or they just have illiquidity risk, right? And it's just, man, we've held this thing for 7 years or 10 years, and I thought it was going to be a 3 or 4 year thing, and we're still kind of waiting to see what happens.
We're 15 years into a 7-year deal.
Yeah. That is a common trend right now in a lot of things.
Yeah. The other thing that, it is interesting is I've thought about this topic and how we're going to talk about it, like if you think about the history of kind of where it came from, you know, so in 2007, early 2008, before things really started to melt down, I can remember giving presentations on the lost decade, right? So there was a 10-year period where the S&P returned zero, right, for a 10-year period. During that 10-year period, there were a lot of other asset classes that performed very well. International was one. MLPs, I remember at one point was, a big high flyer about that same time. And so it's interesting to think about the rise of alternative investments. If you look back across a 20-year time frame, hedge funds have been around since probably the 50s. I think was the first hedge fund was in the 50s, and it was all based on bonds. But if you look back at that time, and the S&P's returned zero, right? I mean, people have a very short-term memory, in particular when it comes to investing. So if you'd invest in the S&P 500 in 1998, and now it's 2002, and at that point, S&P was probably down for that 5-year stretch, right?
Yes.
And somebody comes and says, "Hey, I've got this deal. I've got this alternative investment you can invest in, and it has risk similar to the S&P 500, but it's going to return 12%, 15%, whatever that. I mean, you name the number, you can see where it would be very attractive." And as I think back over the last 20 years, I think that's a lot of what happened, is that there was this period of time where public markets did nothing. So then kind of the explosion of the alternative investments, explosion of the private markets. And so it is interesting, I think, when you look at it through that lens.
Yeah, you contrast it over the last 15 years and you go, well, would you rather own QQQ, which you could sell any day of the week and have cash tomorrow, which what's its average over the last 15 years? Something like 16%?
Yeah, I think it's like maybe 19%.
19%, yeah. So you're like, would you oh, by the way, the fee on QQQ is, 50 basis points, where the fee on a lot of these private equity things are 2 and 20 or whatever it might be. So it's it's kind of the opposite side of that coin.
Yeah, we've come full circle, and it is. If you look at it through that lens, it's very interesting because we have come full circle. Where 10 years ago, 12 years ago, it was really easy to get excited about these private equity deals because you do remember these big breakouts, these big things. But right now, when I look at some of those decks, it's hard to get excited about getting tied up. And a lot of times, again, like so many of these are. It's going to be liquid in 7 years. It's going to be a 7-year hold. But that's really a best efforts kind of contract or best efforts kind of structure. So if you really get into the details, lots of times it's a 7-year hold. It could go out to 15 or 20 years. So it's just interesting when you think about it from that perspective.
They become more of an illiquid investment. It's interesting that you mentioned kind of the zero return years, 10 years or whatever that was, and how most humans have a recency bias where if the market's going up, it's always going to go up. If the market's going down, it's always going down. And we know that that's just not the case, whether it's a venture capital or whether it's the public markets or whatever it might be. Yeah. And so that really drives the question of, when a family comes in and goes through the StoryLens process. We talked about that, I think, in episode 2 podcast. And you're working with them, and you start thinking about with them, and they start looking into their heart and trying to decide what they want to do. What is the diversification? What is the, mixture of these different types of assets? How do you walk through that with them and help them understand what might be beneficial for them?
Mm-hmm. Yeah, it's interesting. I mean, I think I think more from a standpoint of recency bias is real for all of us. When I think about most families that want, $500,000 a year, $750,000 a year, $1 million a year of income, I mean, really, a lot of times it's just an equation, right? So if you go with a withdrawal rate of 4%, which is maybe too aggressive, maybe too conservative, but that's kind of the historical rule of thumb, then that's what would be a really good thing to hold in public markets, in my opinion, right? So a lot of times that ends up being 15, somewhere between 10 and $20 million of public markets type securities. And again, that's not very exciting for a lot of people. but it is like the returns on that. Like right now, I think, we looked at some bond portfolios the other day, and yield is 4.5%, and that's on muni bonds, so it's tax favored, but that's just not that exciting. And a lot of people with wealth come from the business world, and it's pretty normal in the business world to have your business grow at 30%. It's fairly normal to have your business return 30%. So all of a sudden, when you start talking about, hey, we're going to get you a 4% return on this bond portfolio, they don't get very excited about it. But it is. I think that, so point being is a lot of times what we talk about is like we do run financial independence modeling, and that financial independence modeling will say basically what the dollar amount is that'll fund your lifetime plus 10 years, right? So then it's a little bit of more of a art than a science on how do you get to that mix. But it is like for some families, it's like, hey, we need $15 million to produce the level of income that we want on an annual basis. So then it's like everything above $15 million, what do you do with? Does that go into alternatives? Does that go into private real estate? Does that go, where does that go? Then there's some families that quite frankly say everything above that, the number that we need, goes to charity. So it is just interesting that, again, like as of late, we've been much more excited about public markets than private markets.
Yeah, I mean, I think I've got a friend who runs a large endowment for a university, and we were sitting on a flight, and I was asking, like, what does this really look like in the day-to-day? And he's like, you know what, Cameron, I spend most of my time making sure we don't make dumb decisions. Right? So it's much less about going to chase the large returns and say, oh, here's this sexy new thing that's going to get us 20% or 25%. It's more like, let's not make bad decisions. Let's be steady Eddie, and we will do well, and we will achieve the goal we set out to achieve. Now, obviously, every family has different goals. Every family's kind of different of where they are in their timeline. We work with some older families who recognize that they have more wealth than they'll ever need. And so they have a lens of, actually, I'm growing this for the next generation, the next 2 generations. And so they're risk on all day, and they're like, it's great. They don't mind if it's, the volatility. But I think John and I have learned through experience that the attractive deal that your friend did, or that, this new startup in town, there's a proper allocation of those things. But I think I would put them in the bucket of start very light and expect no return. So don't get over your skis early in some of this exciting venture capital stuff, just because, as we've already said, like you get these really long holds. We've seen them dry up. We've seen them go from, a $500,000 investment, looks like it's $2 million on paper. COVID happens, it's zero. It's gone, and so I do think it's just, we are more tame today than we were even 5 years ago, and just saying, let's kind of ease into these things and let's do smaller allocations, because it can be painful. And
there's an element of stewardship that's a part of it. I mean, the interesting thing about this profession is you are gaining technical skills, but then you also are having your own experience, right? So we get to walk with families as they experience things, and it is just like, if a family decides to make a speculative investment and that amount goes to zero, that they kind of went into it knowing that amount goes to zero. But if you go at it from a lens of, this money's the Lord's, what would he have me do with it? Then you maybe are a little more conservative with it. Because again, a lot of our families is like, there's an element of, we're going to give X number of dollars to our family, and the rest is going to charity, right? So if you make a $500,000 investment today that goes to zero, that's money that's not going to go to charity. But if you make a $500,000 investment today, and it, even if it compounds at 7%, in 10 years, it's going to double. So those are the kind of, it's just a little bit different lens. And I think some of that is just walking with families as they've experienced quite frankly, the capital loss of some more speculative investments.
Yeah.
So the buckets that I try to simplify things for myself, I talk a lot about giving, living, and growth buckets.
Mm-hmm.
And you had said, John, that, the first step is how much do you need to live?
Yep.
To pay for the mortgage or pay for groceries or whatever it might be, right?
Yep.
And then it's, do you want to give above that? And then how much do you want to grow?
Mm-hmm.
From a growth standpoint, that's where we typically think about asset classes.
Yep.
And we think about returns for the most part.
Yep.
And with those returns, there's a risk in a lot of different ways. I know for me, the current Kenny versus the Kenny 30 years ago thinks about risk way differently.
Sure.
I also think about liquidity way differently than I did 30 years ago. So as you're going through this and thinking about liquidity and risk, what are some of the kind of the questions or discussion points that typically come up?
Well, to pause on that for a second.
Yeah.
30 years ago, have there been some experiences or things that you've learned in that 30 years that really spoke to you that said, oh, wait, I need to shift, or is that just age and wisdom? What is that?
Yes. So, as you go through life and you do begin to invest in the public markets, you do start looking at alternative asset classes.
Mm-hmm.
You start realizing that liquidity isn't just a term. It's really something that's tangible. And a lot of times, you don't really understand what liquidity means until you're in a point where oh, that's what that means.
A lot of times you don't know what it is until you don't have it and you need it.
It's too late. So what is it? What is liquidity? Let's just talk about that really. At the end of the day, it's how can I convert something to cash quickly so that I can do something with it? Medium of exchange,
sure.
right?
Yep.
Even cryptocurrencies weren't liquid. It was really hard for a long time to get just a cryptocurrency back into cash. It's a lot easier now, but for years it was really difficult to be able to do that. So as you're going down the continuum of different asset classes, risk is high or low depending on the asset class, the investment, the stock or whatever, but liquidity is a little bit different. Cash is the most liquid thing, right? You go to your bank, you get cash, you're good. The next kind of piece of liquidity that I think of is the public markets. And because you've got, the New York Stock Exchange, you've got the SIBO, you've got NASDAQ. Well, you own those stocks. Those stocks trade 252 days a year or 50 to 250. You can go, you can sell it today. And that when you sell it tomorrow, you've got cash, basically, in a T+1 settlement day. So you're liquid within one day on that stock. That's a good thing. It gives you flexibility. Now, in a 401k and things like that, there are tax consequences, but you kind of get the general principle. If you go into bonds, a little bit harder to sell. If you want to do that, but the risk profile could be different on a lot of those bonds, and it could be a good asset, mix within your diversification. As you start walking down to private equity, depending on what that might be, real estate, depending on what that might be, venture capital, which is probably generally the most risky because you're kind of betting on founders and ideas and making sure that they've got enough capital. Liquidity on those things kind of dries up. There's really no exit on a lot of them. And you are bought into the idea that you believe in it, it's going to work. And a lot of times it does, and a lot of times it doesn't, honestly. But if you need the cash and you just invested in, the greatest thing that came around in technology, well, you can't sell that. It's very, very, very difficult to do that. Or even a real estate fund, very difficult to sell. And if you do, you sell at a big discount.
Well, that's what I was going to mention is that now there's like a whole secondaries market across all these asset classes. And these secondary markets are, hey, you bought that venture capital thing or that private equity thing or that private real estate thing, and now you want out because you want liquidity. You're going to take, probably on the low end of the spectrum, a 20% haircut.
Yes.
Probably on the big, there are probably times where you could take a 60%, or there's just no market at all, right?
Which happens a lot.
Yeah. So it is this thing where it's like that secondaries market is alive and well. I think it's actually going to become more and more vibrant, but it is interesting. Like as you think about it, like you can get out. It's going to hurt and cost you a lot, but you can get out. Yeah.
So how do you vet these deals, John? What is your approach to that when you do say, okay, this is a green light?
Yeah, that's a good question. A lot of it is, I think again, like when we're filtering things, I think it is, public markets, private markets. And then a lot of times, quite frankly, the next big kind of sorting place is professional management, not professional management, right? So if somebody says, hey, I want to put $500,000 to work in the technology space, and I really like this private equity manager, and they're going to launch Fund 5, and Fund 5 is going to invest in 10 different businesses, the risk characteristics of that investment is a lot different than, hey, my friend Kenny, who lives next door, is starting this new technology thing, and he's trying to raise $5 million, and I'm going to put $500,000 into that. So, the fund would be professionally managed. Kenny's would not be professionally managed. So the lens through which I look at the fund, where it's got diversification, professional management. These professional management, if you ever read a book about the history of hedge funds, or if you read books about hedge funds, like, these fund managers are literally the smartest people on the planet.
Yeah,
right?
They're all MIT quants.
They are.
Yeah.
They're literally like MIT, Cal Poly. These are like the smartest mathematicians on the planet. Very
intelligent, yeah.
Right? And so when they look at risk, when they're measuring risk, there's an element of they know what they're doing, right? And so it is a thing where it's like, just like Cameron was saying, is like, the big thing is not blowing up. So, and we're not necessarily talking about hedge funds, but really, like, a hedge fund manager, their main goal is don't blow up. Because if you're a hedge fund manager and you blow up, guess what? As a professor in law school would say, you don't get invited back to the party, right?
Yeah.
And so it is a thing where it's like, venture capital is a little less that way. So I think when we're vetting these deals, a lot of times if we look at if it's professionally managed, then it gets into kind of what's their track record. Who are they? What are they trying to do? What are they trying to accomplish? Because it doesn't necessarily need to be sexy for it to be a good investment. So we have a few families have invested in a fund, and they actually describe themselves as permanent capital, not private equity or private So what they want to do is they want to partner with businesses long term. But a business, again, our business can return really good returns from a standpoint of cash flow, from a standpoint of growth. And so looking at them, it's just like, this is not a super exciting investment, but it is one that we believe in because we believe in the manager. So it is a lot of times reading the deck. Does the manager have history? Do we have somebody that's invested in this before? The other big thing a lot of times is, has there been any return of capital, right? So when you start getting these illiquid deals, if you invest with manager X, if you said, hey, I'm going to put $1 million with manager X and he's going to go put it in Fund 1, well, as soon as Fund 2 is available, manager X is going to come back to talk to you, right? So it is a thing where it's like, at some point, if manager X has never sent you money back and he's only taken money, we might hit pause and go like, let's wait until one of these funds actually returns some capital. So it's a lot of research. And then quite frankly, a lot of times it boils down to, do we trust the manager? So, yeah.
So I've been reading Ecclesiastes, and it talks about diversification in there, get into 7 investments, get into 8, whatever it might be.
Yep.
So, most people do not just say, I'm going all in on venture capital and that's it, or I'm going all in on public, so there's a little bit of mix. What type, when you're looking at the buckets, can we just call them the buckets?
Yep.
Yeah.
And you say, okay, well, if you have a T+1 liquidity for equities,
Yep.
okay, that's going to return whatever, 8%, 9%,
Yep.
whatever it might be, right?
Yep.
What more of a return do you need as the liquidity profile decreases? So if you go from, let's just take the continuums here.
Yeah.
I'm going to move cash out of the way. We all get that.
Yeah.
So if you go from like the equity markets, and you go all the way over to venture capital, like what kind of a return do you need to look at in that deck with the illiquidity profile, with the tremendous risk, that's out there?
That's right.
To a public equity of an 8 or 9%.
Yeah. Well, again, I think a lot of it is like what a business owner would want. A business owner a lot of times wants a 30% return, right? If that's through the profit margin on their business, through the growth of their business, the growth of their equity. So I think a lot of times that venture capital, it is like that 30% annualized kind of thing. The interesting part is there are, quite frankly, venture capital celebrities now, right? So there's this podcast called All-In Podcast. It's four guys that have become billionaires, some of them off being founders, some of them off being, investing in some of these startups. But, those returns aren't 30% annualized. I mean, some of them invested in Uber early. Like, those are like thousands percent annualized. So it is a thing where it's like, I understand the allure, but it is like, we joke about unicorn hunting, right? So it is a thing where, is this the next unicorn? So, and then Cameron or Kenny, I think you talk about this a lot, like the thesis, right? How much do you believe in the thesis?
And you have to believe 100% into what they're kind of bringing to. I kind of view when you look at equities, if you're in equities, okay, and you're going to get an 8 or 9%, you're not going to accept a 0% return. That's not what you're walking in typically with equities, right? If you're getting the S&P 500, you're expecting some kind of a return, and you'd be very disappointed. The likelihood of it going to something very low is not high, right? When you go to the other continuum of venture capital, you have to expect a 0% return. And so for that expectation, generally, you've got to have a much, much, much higher possible
I
return.
mean, what is the, and I did look this up, I think 6 months ago, when I had a client that wanted to invest in VC, like, what's the success rate? Like, what do you guys guess the success rate is on a venture capital where they go out and raise outside funds?
They're probably like 35% maybe at best.
I'm going mid-teens.
Yeah, I think it's mid-teens.
Mid-teens. So I believe
mid-teens, single digits. And again, it's just like, and what I love technology. Like, if I had to pick an asset class to invest in, and this is not a recommendation, over the rest of my career, it'd be technology. I love technology, right? We're on the front end of some very exciting things. But there's also, like, technology's super competitive space. And again, some of the smartest people on the planet are, like, crowding into, like, this space. And so it is just fascinating to think about, like, 90% of them fail, 95% of them fail.
But I think the bet for VC on high tech and things like that is, like you said, one's going to be 1,000% return, which is going to make up for a whole lot of the ones that don't. So you've got to have a few in those.
Well, and that's back to Cameron's point, is that, I love diverse. I mean, again, like, there's a lot of people that sit in the seat that we're in, that their main goal is wealth protection. And we absolutely believe that wealth protection is part of our mandate, what we do for families. However, we're also entrepreneurs. We believe that, capitalism is a great thing. We believe that, again, we're stewarding assets. So this thought that we're just going to play defense all the time, like, that's not really where we are. But to Cameron's point about, like, diversification, like, instead of making one bet of $1 million, why don't we make 10 bets of 100,000? And it is just this thing where it's like the game of averages. It's just, that one could turn into the unicorn. But oftentimes they don't.
Well, we've kind of alluded to this, but we run this financial independence for families, and we say, okay, if this is true, this is what you need annually, adjusted for inflation, et cetera. We say that number's $9.5 million, and then we say, okay, let's keep that in pretty secure, pretty liquid things, and then beyond that, we start to ask questions of, okay, how much of this do you want to put in the bucket of, if this goes away, I'm not going to lose sleep over it. Or like our conversation with Amy, like, there's opportunity to do impact investing, things that really connect to your heart. So we have a friend who loves to do some investing in this space, and he's like, it's the return is awesome, and I love to see it, but I love to feel connected to supporting people who are in this space, right? And so that's a wonderful thing. Builds relationship in your community, has more meaning than just owning, the NASDAQ. But obviously you have to be intelligent with the allocation of something like that, right? And so, I think just allocating, say, okay, we look at your balance sheet, what is the number? Is that $2 million, or we say, hey, this is the money you can go in, but that's the amount. Until we get some return and build that bucket up, that's where we're going to stop. And so if you want to put it all on black, do $2 million in one investment, you used it all. Usually people don't want to do that. So it's more like, how about we cap it at 100 per investment, and then we can go kind of play in a lot of different spaces, build a lot of relationships, and it's a lot more engaging.
Mm-hmm.
Well, it is, I think. And when you get back to kind of what are the buckets, or what are the right percentages, it is kind of funny. There's tons and tons of research on what's the right asset mix, right? And it always kind of comes back to this 65-35, 65% equities, 35% fixed. Now, there's 100 arguments one way or the other whether that's the right mix. So then it's kind of everything after that, right? So everything after that, sometimes we have clients that come in and say, hey, I've got this private real estate deal, this private equity thing, this venture capital thing I want to do. Quite frankly, part of the filter is if this goes to zero, is it going to change your lifestyle?
Yeah.
Is it going to have a material
That's
impact
a big one.
on you?
Yeah.
And if the answer is no, there's a lot more freedom.
Mm-hmm.
If it is going to have a material impact on you and your family, then it's, there's our times where we try to stand in front of the train and be like, time out, let's not do this, or time out, let's do a smaller amount to this.
Mm-hmm.
And again, like there is an element of like, quite frankly, people pay us for our opinions. So there are times where we'll have an opinion on something is good or bad from a standpoint of what's best for the client.
Yeah. Talk about real estate for a minute. I know you're not a huge lover of real estate, but like it's an asset class that people love, people feel passionate about. I think there's there's a lot of noise around, hey, build this thing that just generates capital, and you kind of don't have to work anymore, that kind of thing.
Well, the other good thing,
cash flow. It generates cash flow.
Generates cash flow,
the other good thing about real estate, right?
It's
the two. It never goes down in value, and they're not making any more of it. If I had $1 for every time somebody told me that.
Yeah.
No, it is interesting. I think I don't dislike real estate. It's just I think that there's a lot of misinformation. I think there's a lot of people that, quite frankly, don't understand how real estate really works. I think I think there is an element of like we work with a lot of people that have private real estate, and they say the building that I own on Main Street is worth $5 million. Main Street dries up, nobody works or goes down there anymore, and you ask them, what's that real estate worth? And they'll say, it's worth $5 million. Meanwhile, when they get an investment statement every month that says, hey, your account went down 2%, or your account went up 2%, right? So the fact that there's no like mark to market on real estate,
it's hard to value.
Yeah, it's super hard to value.
So it's and a lot of venture capital's hard to value. Private equity, real estate, it's more difficult.
Yeah, but really, I guess the kind of the mixes or the asset classes that we talk about in real estate are commercial industrial is kind of one category, and that's really warehouses. Then it would be multifamily, office, and residential. And we work with a lot of families. We have a lot of friends that have kind of done each one of those asset classes, and each one has kind of their pluses and minuses. I'd say the one that's the most beat up, and probably for good reason, is office space right now. Office space has had really tough run, and I think it's not going to get better in the short term. I think there are pockets where office is fine. I think a lot of mid-major, large cities, I think office space is going to have a lot of trouble. And then, you kind of get into industrial. Industrial's been really hot for 10 years. And quite frankly, industrial a lot of times is just warehouses. And this is your Amazon warehouses. Yep. These are your smart warehouses. These are places that we're really doing a lot of B2B shipping, that kind of thing. And that's a pretty good investment. Multifamily, again, I think there's a shortage of housing. I think nationwide, I think in Kansas City, there's a shortage of housing. So I think there's some need for housing. So I think multifamily is an okay investment. But really the trick on most real estate investment is there has to be some type of a kicker, right? So a lot of times if people that are developers that do really well in real estate, they get some type of government participation, right? Whether that's through a bond issue or whether that incentive bond issues, like I've seen everything from, hey, we're going to add an on-ramp to the interstate right there by your new industrial park, well, all of a sudden your industrial park's a lot more valuable. We're going to put utilities in for your industrial park. So there's a lot of different ways, but I mean, quite frankly, that's where a professional manager, in my opinion, in real estate are worth their weight in gold. So, yeah, but it is. Yeah. The other thing is that real estate's usually a pretty tax efficient investment because you do get a lot of a depreciation. You get some losses on the front end, that kind of thing.
Yeah. And I think another thing to mention briefly is that, donor advised funds, most of our clients have sizable donor advised funds. And that is also a place where, you can explore some investments in the private equity space.
Yep.
Real estate sometimes works okay in there. But it is a fun way to participate with a slightly different lens. Sometimes people have a little bit different risk tolerance for the donor advised fund.
Talk about that.
Talk about that.
Talk about the different risk tolerances for the donor advised fund.
Yeah, well,
because sometimes it's counterintuitive.
Yeah. There's two. I mean, there's two ways to think about it, right? There's like, okay, this money's in a donor advised fund. It's for charity, and this was a big deal. I gave part of my business before the sale. Took me a lot of work to get $1 million in there, and I'm going to treat it like an endowment. I'm only going to give away 4%, and we're going to do conservative investments, right? That's one side of the spectrum. I think the other is, hey, this is the Lord's money. Like, we're going to go have some fun with it. We're going to go spread in some high risk stuff and see what happens.
Yeah.
And we've seen that work and be successful, and we've seen donor advised funds go from $1 million to $3 million in a short period of time, and that family has a lot more to give away. So it's really exciting. But I wouldn't call it another asset class, but it's like another asset location, right? It's another place where you might have investable assets. And sometimes it's just shifting the lens of saying, hey, this isn't a good fit here, here, or here, but contingent upon your values and your vision for your donor advised fund, it might say, hey, we could do an allocation through that lens. And that's a pretty unique and cool thing about donor advised funds.
Well, that's a lot of times, that's the other thing that we talk about, like asset allocation is the old, like that's what everybody talks about, but then it's like also asset location. So you have something like real estate that's tax advantage. That'd make more sense to hold a taxable account or in your taxable name. You have something that's tax disadvantage. That'd make more sense to hold in a Roth, maybe holding your donor advised fund. So that asset location actually has a huge impact on your income, because if you have a great return, but tax eats it all up, then you don't really have a great return.
And I think it's important we kind of wonky on all these categories, but I think at the end of the day, it's really important to align it with the family, right? So who are they? What do they want? I mean, we're never going to push a product, push an idea, push, venture capital on a family. It's like, this isn't the right fit, right? We want to do extra work on the front end, understand the story, understand mission, vision, value goes for that family, so that, we do have families who bring a deal to us and we review it and we say, might have a decent return, but it's really not a good fit for your family. Right. It's not something that you'd be necessarily be proud of if everyone knew that you were involved in this thing. And so
does it fit with your values?
Yeah, does it fit with the values, right? There's the human side of it, right? And then, Amy mentioned before this is just, the other parts of the balance sheet, if you think about not just through a financial lens, but also how's the relational health of the family, right? How are you guys doing? That's a big piece, right? Faith, if faith is present in the family, like how is that? Just this more holistic approach to thinking about your family, not just from here's our investment value, here's our balance sheet, here's our internal rate of return, but more like how is the family doing holistically? So expanding or broadening the general understanding of what the balance sheet truly is.
Mm-hmm.
Yeah.
It's also a little bit about perspective. It's people have different perspectives on money and wealth, and one question is like, where do you begin? If you begin with, it's all the Lord's anyway, what's my job with whatever I need to steward? And that it's always going to be, well, you got to take care of yourself and you got to take care of your family, and you have to steward them well. So there goes back to your living bucket. Like, am I doing the right thing from a living standpoint? From a investing standpoint, I've kind of learned, kind of like liquidity and kind of like, other things, I've kind of learned over time that it's absolutely important to think about return. It's absolutely important to think about the risk involved, the liquidity involved. But, I've also thought a lot about, what currency am I thinking about? Is it a dollar sign or is it the currency of people? And is it the currency of impact? And so, if you take that lens, like you said with the Impact Foundation, there are certain investments that make a tremendous people impact, but the dollar impact may not be quite as high, right? And so it's really kind of your perspective on that in particular investment, how much you want to allot to that particular investment, and how you walk through it. So we've spent time talking about different asset classes. We've kind of scratched the surface on cash and liquidity and venture capital and private equity. And if there's anybody who is interested in discussing these things more, feel free to reach out to us at StoryOne.com. Happy to do that. But we're probably going to land the plane here on this for this segment. We're grateful that we're able to be here and take this journey with everybody who is listening to and watching the podcast. Certainly, always grateful to talk to you guys. I know you have a lot of thoughts on investments and everything, and it's always fun to kind of have this discussion with you.
One of the exciting things, big shout out to Cooper. Cooper just passed his CFP, so we're super excited and thankful for him. And
nice work, Cooper.
Way to go, Coop.
Absolutely. So thank you. Be sure to follow us on Apple Podcasts, Spotify, and YouTube so that you don't miss an episode. Look at the previous ones and certainly this one. And until next time, we're grateful you've been on this journey with us. Thank you, guys.
Thanks, Kenny. Thanks, Cam.
Yeah.
Thank you for joining us on the StoryLens Podcast. If you're navigating complex financial decisions, we're here to help. We know your story is anything but ordinary, and that's why we start there, because the right solutions are as unique as you are.
StoryOne Family Office, LLC, or StoryOne is a registered investment advisor, RIA, registered with the United States Securities and Exchange Commission, SEC. Registration as an investment advisor does not imply a certain level of skill or training, and the content of this communication has not been approved or verified by the United States Securities and Exchange Commission or by any state securities authority. StoryOne renders individualized investment advice to persons in a particular state only after complying with the state's regulatory requirements or pursuant to an applicable state exemption or exclusion. All investments carry risk, and no investment strategy can guarantee a profit or protect from loss of capital. Past performance is not indicative of future results. This podcast is intended for informational purposes only and is not intended as the sole basis for financial decisions, nor shall this be construed as advice for the financial needs of any individual. StoryOne is not permitted to offer, and no statements made during this podcast should constitute legal or tax advice. The information contained herein has been compiled by independent third parties, have been obtained from sources who are believed to be reliable. However, accuracy and completeness cannot be guaranteed by StoryOne.